Investment advisory services are offered through Fusion Capital Management, an SEC-registered investment advisor. The firm only transacts business in states where it is properly registered or is excluded or exempted from registration requirements. SEC registration is not an endorsement of the firm by the Commission and does not mean that the advisor has attained a specific level of skill or ability.
Welcome to Navigating Retirement with Rick Durkee.
And we're back here with the president and founder of the Coastal Financial Planning Group, Rick Durkee, continuing our mini-series on reducing your taxes in retirement. Rick, the baby boomer generation has enjoyed tax deferral during their working career, saving and investing and accumulating their retirement dollars in tax-deferred accounts. We've talked about the fact that we need a better education and maybe rethinking the way that we are taught about our retirement accounts and tax deferrals. Now, a lot of people don't really realize this, but there's a potential for a compounding effect, kind of a double or triple whammy in the wrong direction, where those tax-deferred dollars could actually cost us even more than we expect in taxation.
Yeah, Peter, first and foremost, we have to look at the fact that during our working career, we were investing in our retirement accounts. We were building those accounts. We were watching them grow while in deferral. And then we reached this point where we have to start taking out distributions. Now, some people might have to start taking out those distributions from those accounts early in retirement. They may not have saved some other side accounts that are tax favored that they could draw off of and wait to take those monies out at age 72 now, when you have to start taking withdrawals from your IRAs, your 401ks, your self-directed IRAs at this point, because you've moved out of and transferred your assets from your 401k to your IRA. But we need to look at the fact that now we've reached this second phase after our accumulation to our spend down years, and we have to look at where that money's coming from. We have to blend it all together: taxable accounts, tax deferred accounts, tax now money, tax later money, tax never money. We have to blend all of those plans in our written income plan, as we talked about earlier in the series. And then we have to look at how we could get double whammied. We could get that left-right combo, man, and get knocked out right in retirement. We don't want that, do we? We don't want to get knocked out in retirement from the IRS and pay higher taxes. So we need to look at how we take money on an income allocation basis from our different buckets of money that's tax now, tax later, and tax never. Now, there are other accounts that are going to be affected and give us that left-right if we're not careful. They are our double whammies, as we'll call them, okay? They are our Social Security. We need to look at Social Security and how it's affected by taking withdrawals from our IRAs. Do we put that provisional income formula or our combined income up into places where we could actually pay on 50% of our Social Security benefits? We could actually pay our ordinary income tax rate in retirement that might have gone up also because of our withdrawals that we had to take in retirement from our IRA account. So properly timing this is critical to avoid money slipping through the cracks. Secondly, we could also affect, here's the double whammy here. The second thing is we could affect our Medicare. Medicare is means tested. So we could pay higher premiums in our Medicare. These things, Peter, if we look at these individually, the Social Security options, when to take our benefits in Social Security, how to take them, what benefits we can look at from income planning standpoint to avoid Social Security taxes or higher Social Security taxes and higher Medicare premiums, are the double whammy that we need to focus on. If we avoid those taxes each year through a 20 to 30 year span in retirement, we're going to save countless dollars in our retirement years.
We don't want to have that left-right combo, the double, triple whammy. We don't want to pay excessive taxation on our accounts in the first place. But the fact that that can compound and cause excessive taxation on our Social Security and our Medicare premiums to increase and be means tested are things that most planning for retirement or even nearing that retirement red zone are not made aware of. You need to plan carefully and get that education. That's why guidance matters. And we'll talk about that on the next edition of our Reducing Taxes in Retirement mini-series with Rick Durkee, the founder and CEO of the Coastal Financial Planning Group. We'll continue the conversation on one of the biggest financial opportunities to move from tax deferred to tax free right now and buy your taxes while they're on sale. Be sure to stay tuned and check in for the next edition of Reducing Taxes in Retirement, brought to you by the Coastal Financial Planning Group.
Catch more of Rick Durkee and Navigating Retirement by visiting cfpgroup.biz.
While we believe the information in this broadcast is reliable, we cannot guarantee its accuracy. Opinions expressed are subject to change without notice and are not intended as investment advice or solicitation for the purchase or sale of any security. Please consult your financial professional before making any investment decisions. Investment advisory services are offered through Fusion Capital Management, an SEC-registered investment advisor. SEC registration is not an endorsement of the firm by the Commission and does not mean that the advisor has attained a specific level of skill or ability. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.